Invest Africa, proudly brought to you by KPMG.
I have my guest, Mohamed Bhaba, Oil and Gas South Africa at Standard Bank, Dr. Duncan Clarke, Chairman at Global Pacific and Partners International Limited, and in our Nairobi studio we are still joined by Mwendia Nyaga, CEO at Oil and Energy Services Limited. Again, gentlemen, welcome back. Let me come to you, Mohamed. Let's look at how we are financing the projects in the oil and gas space. What are the major trends? So,
in the upstream space, a lot of the initial exploration work is funded purely equity funded. Once there is a proven reserve, financial institutions like banks get involved in reserve-based lending. That's on the field itself. On the downstream side and the infrastructure side, development finance institutions would get involved, states would get involved, as well as the banks. There are also opportunities, coming back to the point of local industries. There are also opportunities for entrepreneurs within those countries to get involved in the sector early on. So you would have your EPC companies, your O&M companies, suppliers to your oil exploration companies within, say, for example, Mozambique, Kenya, who can develop industries locally. In addition to that, sort of logistics companies, catering companies, which you may not automatically see as being an oil and gas company, but they all sort of support services that contribute.
Let's also look at, linking on to what Mohamed just raised, look at other innovative ways of leveraging capital into the industry. Are farm down deals like the one that's happened in Uganda working? Are they proving to deliver on their set objectives?
Well, I think farm out mechanism or model is a standard in the industry. It's been there 100 years plus, and it does work. It's a shared risk option. Companies will come in, take the upstream equity risk, like Tullow did in Uganda, for instance, come to a point after discovery with the volume of reserves growing, and it's in the development phase where the costs are very, very high. So farming out, farming down, sharing risk, and particularly if you're going through into a long-term export, crude export, and in a complex landlocked country, you would want to do that anyway. And as well as in the offshore in Tanzania, you saw, for instance, a farm out 60% to BG in their 3 blocks where the gas is discovered. Statoil has recently done a farm out as well to Shell. And you see it in Kenya, where you've got various operators now in the offshore as well. So this is a model that attracts more companies, more players into the industry. It sets up a market for effectively capital or capital assets and joint venture deals. And it's a market in terms of which state companies can play, as well as foreign state-owned companies, as you see in Mozambique with Chinese CNBC and ONGC, for instance, coming into the Mozambique deal. So this farm-out model is a fundamental, very important mechanism in the industry, and it's one that should it should never be sort of undermined, tampered with. So if you start putting blockages into it, like capital gains tax up front on the exit of the farm out, you make it more difficult for the players to come in and justify the initial investments. And it's important to keep this flow of funds and interests and corporate intrusion into a country so it can remain on the competitive edge of the game. There's always another country to go to, and there always will be another one somewhere else.
Mwendia, would you agree with some of Duncan's statements around farm outs and their importance in unlocking investment into the region? And what is the Kenyan government thinking about doing in this particular space?
I think the answer is yes, that you know, farming, farm out, farm down is an industry norm, and it has been there over several decades. That's how players are able to share the risk and sometimes bring in stronger partners who have more technical experience and the money to operate the next stage of the exploration and production ventures. And actually, if I look as in the case of Kenya, if looking back the last about 12 or 13 years, the industry has been opened almost without fail by very, very small companies who are comprised of just a few number of people who are seasoned explorers. They go to frontier areas, and they start the exploration there by reviewing whatever data exists. And when they are able to make some sound proposals and sound evaluations of the basins that need to be explored, they go for bigger partners who have more money to join them, who have more exploration experience to join them and execute the work that needs to be done. And these bigger partners rarely come in to open frontier blocks, as we have seen in this region. However, governments have sometimes looked at these with some kind of skepticism and sometimes suspicion, in that these small companies are coming to speculate and then enrich themselves by bringing bigger partners and getting paid a lot of money for the shares that they shed to the bigger partners, which I think is really far from truth, although there may have been one or two small people who go into frontier areas only with an intention to make money. So I totally agree with Duncan Clarke that starting to tax these transactions that enable bigger, better, more technically qualified and financially more capable partners in is probably a step in the wrong direction. Talking about Kenya and what the government of Kenya has been doing, last year in June, in the finance bill of 2012, the government introduced a capital gains tax, which has gained a lot of debate to date, where people who are bringing in new partners are expected to pay a capital gains tax of about 10 to 20%. It is still unclear right now. The tax experts are still discussing these and trying to interpret what it means for different types of transactions happening. But that discussion is already here, and I think some parties have already been affected.
I've got under 2 minutes left, so I'm going to come to you, Duncan, and I'm going to allow you to have final comment and really around lessons that the East African region can learn from the West, especially looking at a sector that is potentially lucrative and because of that has very high political interests.
Well, I think to sum up, I would say retain competitivity in terms and conditions, keep the markets fluid and open, encourage investors from all over the world, but on a qualified basis. I think that's quite a reasonable requirement. And also go for organic growth in the incitement or encouragement of local businesses and industries to get involved, rather than do it on a mandated kind of state-driven bureaucratic model, which has been tried elsewhere and has failed. At the same time, make sure that you can get a quick turnaround between discovery, development, production, and export, because that's the fundamental benefit of the industry, the unlocking of a natural capital for economic growth for the wider benefit of the society.